Jim, I'm imagining you want me to kick this off, right?
Yes, sir.
Welcome. Thank you for joining us. This is Greg Skogsberg, president of TWH Annuities and Insurance Marketing, and we're glad that you are able to take a little bit of time to find out about this fantastic concept that we're excited about bringing further to agents that already work with us and agents who don't. We focus on the annuity sales and life insurance, and it's always a good thing to have something that works in concert with those, and this concept works perfectly with what we're already doing. And it's a great way to make about the same type of commission that you would make with a typical annuity sale. So I'm going to turn this over to Jim Wolpert, the president of Legacy Tree Foundation, and let him explain this great concept to you.
Thank you, Greg. I appreciate that, and we're real excited to be able to share some ideas with you folks today. I think we're going to find some interesting information that's going to be valuable for all of us and profitable, hopefully down the road. That's the idea. So let's get started. Of course, I'm sure you can assume by our name that we are a charitable foundation. So we're a 501c3, which you're all familiar with, just like many charities that you're familiar with. I'll provide a little bit more detail about what we do in a few minutes, but I wanted to just point out that we're a little different than most charities in that we raise our funds mainly through working with financial professionals, just like you guys, showing you how you can help your clientele take advantage of some simple charitable planning tools that are outlined in the IRS code. So needless to say, we would probably be a unique addition to your practice once we learn what these concepts are. So today we're going to be talking or discussing how you can help your clients take advantage of the benefits of charitable planning. But I feel like it's important to know, though, that our charitable planning discussion today is not going to be just about the donating part or giving of an asset to a charity and getting a tax deduction. I think pretty much everyone knows that you can make a deduction to a charity and get an income tax deduction. Your clients, they really don't need you. They don't need us to be able to do that. But what we want to talk about today is the simple type of charitable income planning idea that's outlined in the IRS code that creates income for the clients and or their heirs in addition to those taxable benefits that they can get by doing charitable planning. So let's just jump right in. I want to show you this slide first to kind of get it out of the way for you. Some of the disclaimers, a couple of things. I mentioned that we're a 501c3. This is an educational webinar, of course. Number 4 is important. The plans that we talk about, we call them legacy plans. They're charitable plan giving transactions as outlined in the IRS code. So they're not investments. They shouldn't be presented as investments. They're charitable planning ideas. Obviously, we don't give legal, tax, or financial advice to you or to your clients. We don't give securities advice, and we're not available in every state. We are in most states, but we can talk about that depending on the state that you're working in. We're probably in your state because we're in about 48 of them or 47, whatever it is there. So we'll be good to go there. Now, because these plans are probably new to most people involved in the financial services industry, I'd like to solidify 2 points before we jump into it. And the first one is that charitable planning can definitely be part of your practice. So we're going to show you why and how in the conversation today. And also that you do have clients that can benefit from charitable planning. A lot of people don't think of it as something that they can provide to their clientele. And the reason for that is because there are some misconceptions out there. And so I want to talk about a couple of those misconceptions first and clear the air on those as to why aren't you doing charitable planning in your business right now. The first one comes down to a lot of advisors are saying, well, I don't have many high net worth clients, so I don't think this is going to fit into my practice. And so the answer to that might be, do you have clients who could benefit by reducing their taxes? Because anyone who itemizes their taxes can be a prospect for this type of planning. The second misconception we run into many times is you say, well, I don't have a lot of clients who are charitable or who want to give their assets away. And so the answer to that might be, which of your clients might benefit by repositioning some of their current assets in order to create income tax deductions, maybe capital gain tax reduction, state tax reduction, and income for themselves or for their heirs. So many of the cases that we do are initiated because of some looming tax issues involving some of their existing current assets. So it's not just giving assets, but it's planning and it's repositioning assets to meet tax and income and philanthropic goals that some of your clients may have. And then the last misconception that we see is that a lot of advisors are saying, well, I don't really want to do charitable planning because I don't have time to do that with all my clients. You're not a charity, of course, and so obviously that's an important point. But the problem is you need to get paid when you spend a lot of time doing planning for your clients, and so that's why we're set up to compensate you. We have a 7% compensation built into our model, and so that's what can make it worthwhile to you to add this into the types of programs that you're able to offer with your clientele. And so I wanted to cover those three things to make sure we kind of get an idea of some things that people commonly have in their minds about why they don't do this type of planning. Let's talk about some reasons why you should do charitable planning, maybe on the positive side of it. And I think, first of all, one is because if you're the trusted advisor for your client, that client would want you to be versed in as many options as possible so that they can make informed decisions. I think it can be important for you to help clients view charitable planning as a financial strategy and as much as a personal value for them in their planning. Certain existing assets may have tax issues or be challenging to pass to heirs tax efficiency, and your clients need maybe expect your guidance in making those assessments with them. Third point, there's a lot of advisors we find who incorporate charitable planning advice into their practice have said that it's an important aspect of their client relationship. In other words, they say it's a relationship builder. So whenever you have complete and unique information, I think it usually increases the trust and the confidence a client is going to have in you as their advisor, which lends itself to the next point, which is the client becomes more loyal to you and more confident in you as their financial professional. Because I think when you have more and diverse information, especially in the philanthropic arena area, it insinuates that you're maybe community minded or civically minded, and that tends to give clients confidence in you. And then, of course, the last point, if you're like most advisors, you don't want to be outdone by another advisor who may show up to your client talking about these ideas to your client when you could have them available to be presenting to them yourself. So I think those are a couple of good reasons why you want to implement charitable planning into your practice if you're not doing that already. So that's why we want to get into it. Let's talk about some specifics. With our legacy plans, like I said, we call them a legacy plan. Other charities, of course, might have different titles. But the best description for what it is just the slide itself, that it's a simple transfer of an asset to Legacy Tree Foundation. Securities, annuities, real estate, cash are our four main types of assets we see. In exchange for that, they get a contract that provides them immediate or deferred tax-favored income for life or a set number of years, so lifetime income or term certain income. And then again, because we're a 501c3 nonprofit, there is an income tax deduction, capital gain reduction, and estate tax reduction. And so it's really just as simple as that. I'll actually talk a little bit about these four types of assets in a moment here. But let's see a couple of applications and uses for this type of planning. First of all, again, these are charitable plans, and the organization Legacy Tree Foundation is a charity, so we are getting money to help charitable causes every time a transaction is done. We found that statistics show that 98% of high net worth households and 85% actually of all households are actually making annual charitable contributions. So it is something that people are doing, whether it's with you or our help or not, they're doing them anyway. But here's the thing, a lot of people think charitable planning is writing out a check to charity, to their favorite charity, and then getting the income tax deduction. So that's what I wanted to make sure that we understand, that there's another level in the IRS code where people can make a partial charitable transaction where, yes, they're going to get the income tax deduction, but they can also get the income in return. So let's jump into this. After the fact that we're getting money to help charitable causes, the other two layers of this are creating income for themselves and creating tax benefits. So let's talk about the tax benefits. First of all, one of the main components is that they're going to reduce taxes. Again, it's as simple as that. If you have clients who itemize their taxes, they could benefit from a tax deduction. If they transfer a capital asset to us, part of the capital gain is also going to be eliminated. And almost all the time, either all or a portion of the asset value is going to be removed from their taxable estate. So we're solving that problem as well. Point being, everybody likes to save money on taxes. Low net worth people, high net worth people, everybody wants to save. Somebody that saves $5,000 in taxes likes that just as much as somebody saving $50,000 in tax. It's kind of relative depending on what their level of net worth is. Second point then is a lot of people have applied the deduction in such a way that it helps minimize taxes from Roth conversions that they may have done. Others would maybe like to reduce taxes on RMDs if they have to do that, required minimum distributions. Some would like to even make qualified distributions out of their qualified accounts potentially tax-free. So there's ideas as to how you can do that. And then the last point is the deduction could also help move someone to a lower tax bracket. That can be very valuable because if you can help somebody move to a lower tax bracket, obviously they're going to pay less in taxes, but they also might get an advantage if they were to sell a capital asset, because the two lowest tax brackets have a 0% capital gain rate. So if you can create an income tax deduction, move somebody to a lower income tax bracket, might give them the opportunity to liquidate a capital asset and not have to pay capital gains on it, or at least reduce capital gains. So that can be a huge benefit as well. The other side of the equation is the income then. And again, this is the type of planning where people get income in return. Most of the cases that we do, actually, over time, more income gets paid back to them than was originally put in, which is kind of interesting with the charitable plan. So they're getting more income back than they put in most cases, and they're getting the tax benefits in addition. So the income can be immediate, can be deferred, could be lifetime, could be term of years, could be for themselves. A lot of people like to set up a structured inheritance, leaves a nice legacy for the heirs, leaves them a legacy instead of a lottery ticket. I thought that was kind of interesting that one of my advisors pointed that out. And then the last point about the income is a lot of people use one of the great tools of charitable planning is to use an income or a portion of it to fund life insurance premiums to replace the asset value, and the idea being to potentially get the most value to the kids in the most tax efficient manner. So a lot of people will transfer an asset to a charity, get the tax benefits, create the income, and then use that tax preferred income from the charitable plan to fund life insurance to get the value of that asset to the kids more tax efficiently. So that's a popular planning tool that I'm sure most of you are familiar with as well. So here's how it works. Very simply, client transfers an asset to the charity. Could be one of the four that I mentioned earlier: real estate, securities, annuities, cash. Then the client receives, in return, they get a contract from the charity. And that's a promise that's going to show them what the income tax deduction is, if there's capital gain reduction, if there's estate tax reduction, and then it's going to show the terms of the income, again, whether it's immediate or deferred, whether it's term certain or lifetime. That basically is that. It's pretty much that simple. A couple of side points on this slide would be that obviously we're promising an income to your client many times over many years, because it could be deferred and pay for 15 or 20 years on top of that. So we have to have funds reserved, and so for the value of that future income stream that they're going to get. In our case, instead of investing those reserves into something potentially volatile, we simply invest in an annuity contract from a highly rated and familiar insurance company. So we're setting aside 100% of that present value into a fixed annuity to reserve that future income. And then when it's time for the income to start, whether it be immediate or deferred, in most cases, or many cases at least, we'll have the income go directly from the insurance company right to your client on our behalf to meet the obligations of that contract that was offered in number 2 there. And so that works very nicely for all of us. And then the final point is, this is a charitable planning. And so because of that, we allow the client to be able to recommend a charity to be able to benefit from their transaction. And that's a key component as well to the types of plans that we offer here. Now, we basically have 2 legacy plans that we talk about. One is a term certain and one is the lifetime, which I've spoken of before here. The charitable bargain sale with an installment contract, that's what we do about 95% of the time, actually. And that's the term certain income. You can see the IRS codes there. I wanted you to see that. The other one then is a charitable gift annuity, and you can see the code there. Charitable gift annuities that have been around for like 170 years. 1843, I think, was when the first one was issued. And that pays income for the life of 1 or 2 individuals. And so those are the 2. I just like to show those slides. So one, you can see the codes, but secondly, you can also, I think it simplifies for us that we're really just talking about 2 types of programs here. They're a lot like annuities that you write out in the wild there when you sell annuities, because you fill out an application, you collect a check, and you send it to the insurance company, and you get a contract in return. And this, you're basically doing the same thing, except it's with a charity. So you don't have to collect a check. You can transfer other assets other than cash. And then because we're a charity, then there's tax benefits included. Also, it's important that these are simpler than a trust. These are not a trust. You're familiar with charitable remainder trusts, and those are valuable and important in planning, but these are not that. These are simpler than that. These are just exchanging the asset for a contract. Again, kind of like with an insurance company when you exchange a personal check for an annuity contract. Again, except that there's other assets available in this type of planning. Now, I mentioned 4 asset types that we work with typically. So let's just run through a couple of ideas here. I wanted to show you these slides because I think it'll give us an idea of the type of client that we're looking for, and maybe it'll have some helpful points that you can use in starting conversations with your clientele. So the first one is cash. One thing I'll point out, when we think about some of these assets that I'm going to talk to you about, when we think about many assets, we don't think of them as being problematic. We think of them as being good assets, which they are. But a lot of times the way these cases come about is because of maybe some potential or looming issues or potential problems in the future with some of these assets. Because as we know, most assets perform as expected, during the accumulation years. However, during maybe the income or the distribution years, or at a time when we want to pass assets to heirs, they can become problematic. Like cash, for example, that's not problematic. Everybody wants cash. It's just that right now it's a low interest rate. If you do CDs, you're getting a low interest rate, then whatever growth you get, you have to pay taxes on. So that can be a good asset to use for this type of planning. So let's look at some ideas and the type of client that we're going to look for with this. First of all, the type of client. Really, I'm not going to read all of these for you. We'll just kind of touch on some of the thoughts. Might be a good idea. I'll just put the whole slide up here. It might be a good idea if you want to do a screenshot of the slide. Then you can have all the points here. But it comes down with cash, people that think they're paying too much in taxes. And again, who doesn't think they're paying too much in taxes? So if you have discussions with clients about tax reduction, then they might want to know about these types of ideas. A lot of people have the lazy money accounts, funds and CDs, as I mentioned, where they're not getting much growth, and then what they are getting is taxable. You might have clients that have sold real estate or business or cashed in a qualified account, and now they've got a tax issue to be dealt with. So transferring cash can create a tax deduction. It's a good, sound year-end deduction for people to offset maybe some of those taxes. Again, people that are taking RMDs, that's kind of important because if they can transfer a non-qualified cash asset, it's a nice way to create a deduction to offset the taxes on RMDs. A couple down there, a lot of folks want to provide a structured inheritance for their heirs. We've done several cases actually where mom and dad didn't want the kids to inherit a lump sum, or maybe they didn't want them to inherit an annuity where they could just cash it out. So these programs work nicely to lock in a structured payout to the heirs while benefiting mom and dad from the tax and philanthropic aspect of these plans now. Also, the bottom one there, this is kind of key as well because you might have some highly paid professionals. In some of those cases, if their income is so high, they might have exhausted or maxed out all the retirement funding methods. And so this could be a great supplemental vehicle that could provide immediate tax reduction, for them now, but then they could get income at some point in the future, all while helping charity. There's a lot of wins in that scenario, obviously. A couple of questions you might start a conversation with the client. Would you be interested in discussing ways to reduce your income taxes? Again, pretty much everybody's going to answer yes to that, and so that's a great conversation starter. Are you interested in your heirs receiving part of your estate as a structured inheritance? Again, as we just talked about, a lot of them like to do that. And then accessing funds from qualified accounts. That's a great conversation as well, because if people can do a transaction with a non-qualified account, transferring it to Legacy Tree Foundation, they create an income tax deduction. They pull money out of the qualified account, use the income tax deduction to offset that taxable event that they've just created. And it makes for a real nice scenario for themselves. Securities is another one of the great assets that we use to transfer that come over to us. You have a lot of clients that want to reduce exposure to the market. If it's seniors, they've done well on their securities, but maybe they don't want to be as heavily invested in the market, but they hesitate because of the capital gains. Those can be really valuable types of assets to transfer because not only do they get the income tax deduction, but they also get to reduce their taxes, capital gain taxes as well. So there's a kind of a win-win there. Also, this is a cases where you might have clients who would like to exit the market, still want to get the value to the kids, and so the last point there, maybe they transfer their securities over, they get an income tax deduction, they get capital gain reduction, And now they can use the income to purchase a life insurance policy that can get the value of those securities back to the kids more tax efficiently, potentially. And that would be the idea there. Remember, we're not a broker-dealer financial institution, so we don't give any kind of securities advice. You have to make sure you're properly licensed if you do give securities advice. So that's important to remember that part of it. A couple of questions. Do you have appreciated assets at risk in the market? Would you like to reduce some of that risk? A lot of your seniors are at a place where they would like to do just exactly that, but they're holding out because of the capital gains. If they could liquidate some of your appreciated assets and avoid or eliminate some of the capital gains, is that a topic we should talk about? So that's good. Set up an inheritance for the heirs. That ties in with the life insurance. Real estate, that's also one of our popular. It's actually a kind of a lucrative scenario when we can get real estate cases to work. A lot of your senior clients, might be involved in rental properties or second homes, those kind of things, and they want to liquidate, but they don't because of capital gains. And so these can be great assets. A lot of times they're left on the table because a lot of advisors aren't sure what to do with real estate for their clientele until after they sell it. And so you can be involved on the front side of this and help them find ways to reduce taxes on the capital gains, as well as maybe fund life insurance to replace the asset value to the kids. Because again, a lot of people aren't selling their real estate because of capital gains, or they just don't want to mess with it. But we get involved in real estate cases, and it works really well. The first question on the right there: did you know you could liquidate your real estate and drastically reduce the amount of capital gains that you would have to pay? And so that's a good point, because most didn't know that this was possible. And so you could be the hero when it comes to helping your clients offset some of the taxes associated with the real estate sale and help them get out of the real estate market, especially with seniors. If they're managing properties, they don't want to be involved in these properties necessarily at certain ages. And so this is a great way to help them with that. Annuities, I wanted to get to that a little bit quicker here because this is one of our most popular asset strategies that we see being transferred. And so I wanted to make sure that we talked a little bit more about that one. Because as I mentioned, annuities typically are our most popular strategy, and that's because they're a wise planning tool. I know most of you, being with TWH, you probably sell a lot of annuities, and that's good. And that's why there's like $2 trillion worth of annuities that are currently in force. So we know how valuable annuities are for income tax deferral and retirement planning and income planning. But the point being, if you have a happy client, you're in a nice position to talk about the future of the annuities that they have, or possibly even the annuities that you sold them. Because the second point there, currently less than 5% of folks annuitize their annuities. So it seems most folks are planning on passing their annuities to the heirs, to the kids. And what does that mean? It means the kids are inheriting the gains or the growth in those annuities, which is now going to be taxable to them. I think you'd agree with me, annuities are not necessarily the best asset to be used to transfer wealth. They were designed for income planning. And so, of course, mom and dad are going to be concerned about passing a taxable situation on to their kids. And so a legacy plan that would be funded with an existing annuity might just very well be actually more suitable and beneficial way to get the annuity value to the kids more tax efficiently than if they just pass the annuity on to the kids. Of course, tax reduction is important. So as always, there's going to be an income tax deduction. In this case, it can offset the 1099 gains within that transferred annuity, whereas in an ideal situation when someone transfers an annuity, they can alleviate the 1099 gain in the annuities and also reduce their current tax bill. Also, again, a lot of moms and dads would like their kids to receive a structured inheritance versus a lump sum. A lot of kids inherit an annuity and they want to cash it out, and so this is a great way to alleviate some of that situation for a family. A couple of thoughts about annuities. Questions on the right side there. Do you think you'll access the income from your annuities? A lot of folks aren't. Again, as I said, 95% of folks don't annuitize their annuities. I know some take withdrawals of cash, along the way, but most people don't annuitize their annuities, and it means they're going to be passing those on to the kids. And so that's the next question. Are you concerned about passing tax consequences on to your heirs? Great question to ask. To a parent who's concerned about that. Most of them are going to be concerned. Third question, would you like to create a structured inheritance for your heirs instead of giving them a lump sum? Of course, that's always a popular thought, especially with maybe one or two kids that don't handle money well. And then the last question has to do with could you use a tax deduction now, still like to have income available for yourselves, your heirs at some point in the future. And so that's a great idea as well. So annuities are something we really need to take a look at. And I'm going to actually give you a case study here that we can help us think about this a little more seriously, about how annuities might be useful in your practice to help some of your clientele more efficiently tax the values, pass the values of these onto their heirs. Herb and Ruth Aarons wanted growth potential tax deferral. They purchased a fixed annuity for $100,000. It's now worth about 104. I'm sorry, it's now worth 120,000. So it's got a surrender value of 104. So what we're concerned with is that 20,000 gain there. They have two concerns. Like most people, they pay too much in taxes. If the children inherit the annuity, they could have to pay taxes on it twice. One being they had to pay the gains in the annuity, but secondly, if they're in a estate tax issue, they could pay estate taxes on it as well as the growth in the annuity. So here's what we do. It's going to look just like the chart we showed earlier. They transfer their 120,000 annuity over to Legacy Tree Foundation in exchange for their legacy plan contract. We're going to issue our legacy plan contract at the full 120,000, even if the transferred annuity is still in its surrender period. And that's because that's the value the IRS is going to recognize that they transferred to the annuity. So even though we're actually getting the surrender value, the tax deduction can be based on the accumulation value, and that makes for higher tax deduction. So that's why we do it that way. A number of factors are going to go into the case design then to determine the amount of income that they'll end up receiving. The term of the payments, how long they're going to defer it, what the surrender value is, if they want more income or if they want more to go to the charitable component. For the cost of our reinsurance will all play into how that's going to play out. But in the end, they're going to get a contract that's going to spell that all out. So let's talk about this contract. In this case, this is going to create a $48,000 plus income tax deduction. If they're in a 25% bracket, they're going to save about $12,046 on their taxes, put that money right back into their pocket. So the key here and what we're able to do is to use this new tax deduction to offset that $20,000 of tax deferred growth. It allows them to settle up with Uncle Sam now so that the kids won't inherit an annuity with a lump sum tax attached to it. And if that deduction is large enough, as it is in this case, it's going to also reduce their regular tax liability because we offset the $20,000 of gain. Now they've still got $28,000 extra of deduction that they can use to offset the regular tax bill. So that's the value of that tax deduction in a case like this. Secondly, though, they're going to get income. This is 5 years deferred with a 20-year payout. So after 5 years, they're going to start getting $7,502 a year for 20 years. For most of the cases we do, as mentioned, the parents don't plan on taking income. Now, they still have the ability to access this income if they want, or they can name their kids as beneficiaries. This is nice because, again, it can set up the structured inheritance maybe for this portion of their estate rather than kids getting a lump sum on this. Now, because we're promising that long-term income, we're going to ensure that future income stream. We're going to reserve funds. So we simply invested in an annuity contract from a highly rated and familiar insurance carrier, as mentioned, to ensure that future income. So the income benefit in this case is $150,000 that it'll pay out on that $120,000 annuity, plus the tax benefits that they're getting at the outset. So again, this is an important concept to consider because three things. One, some of your clients are never going to access the income from their annuities. Secondly, they'd like to avoid passing a taxable event on to the children. And third, they could benefit from the tax deduction this year. So it's real important to think about clients who might be able to benefit from this scenario because that's one of our most popular scenarios. And because there's a lot of annuities out there and a lot of them that you've even sold, and as people get older, there's not much that they can do with their annuities at a certain point in time. And so you can, again, be the hero there and help them with something that potentially could be more suitable than just passing it on to their heirs. So that's enough about assets. What's in it for you? We compensate you 7%. A lot of times advisors, as mentioned, avoid this type of planning because they need to be compensated. So we're set up to compensate you 7%. Could vary depending on the state you live in, but it's just simply the referral fee that we've built into our model. A lot of charities do golf outings, fundraisers, banquets, those kind of things, but it's just more efficient, we feel, for us to allow that fee to go to you when the transaction happens. You've done the work, help clients save on taxes, maybe increase their income, pass assets to kids more tax efficiently, and help money get to charitable places that it may not have gotten had you not helped your client. So we feel that's a value. Secondly, and this is two key components on there, I should probably have them bolded a little brighter, but we can issue our contracts at any age. You know what that means for you, because a lot of contracts can't be issued at certain ages. And then secondly, we don't reduce the comp as the client gets older. So that's valuable to you as well. So if it's beneficial, suitable, good for the client, then it works well in your practice as well. The other thing that's good for you is that, again, the way we reserve our funds, because that income obligation we have to your client is going to be insured with a highly rated insurance carrier. So we don't self-insure these. We don't invest in more volatile or uncertain investments. We just invest them into a fixed annuity that's going to basically guarantee, based on the claims paying ability of that insurance company that we're using, that those funds are going to be there. Every contract we've ever done is insured this way. Charities aren't financial institutions, so you just need to make sure that the funds are put away properly, and that's why we wanted to do it that way, to give you peace of mind, to give us peace of mind, but most importantly, to give your client peace of mind when they do these types of transactions. The last thing that's beneficial is some flexibility and control in the charitable component, and so we allow your client to be able to recommend charities that they would like to see benefit from their transaction. And so that's very, very important in these as well, providing some flexibility on that. Legacy Tree Foundation, again, is a 501c3. We've been around since 1999, so we're about 18 years in existence. We do charitable things in order to be and remain tax exempt. And so our mission statement is to provide spiritual, physical, and humanitarian aid to those in need. That's what we do as a charity. We have 6 specific charities that we provide grants to, but as mentioned, we also allow your client to make a recommendation as to charities that they would like to see benefit from the portion of the charitable component that we share with them. So if your client would like to help their local church or a homeless shelter, maybe a food bank or college, or we see a lot of folks recommend Wounded Warrior, St. Jude's, Children's Hospital, or something like that, then they can recommend that or those organizations benefit from their transaction. We find that to be real helpful. Really what we're trying to do here is to make an adjustment in who the primary beneficiaries are of your client's estate. I like to call it, what happens now, it's what I call involuntary philanthropy, where the U.S. government is the beneficiary for a lot of the clients' assets after they pass, albeit uninvited beneficiary, I might add, for those types of assets. So what we're trying to do is change the position of those and change the order so that it's the family first, and then charity, and then the government. And this is a great way to be able to do that for your clientele. So a couple of points I want to make in summary is that, first of all, you do have clients who would like to reduce their tax bill. Some have to take RMDs, some may have done Roth conversions, some maybe would just like to access qualified funds. And so charitable programs can be structured to help in these situations. You have clients that have appreciated securities they'd like to exit from, especially if they're seniors, but they hesitate because of the capital gains. Again, these are types of programs that can help exit from those types of assets in a more tax efficient way. Again, think of the clients that have some real estate that they're in a position that they might want to liquidate, but the capital gains are causing them some hesitation. Those are great clients to want to talk about. And again, of course, all of you have annuity clients who plan to pass their annuities and the internal tax issues on to their heirs. And so a lot of people have done a suitable plan with us to offset some of those annuity gains that the kids stand to inherit. And again, I've said this before, but the truth is it may be more suitable for them to do our legacy plan program than to simply pass the taxable annuity on to their heirs. With the DOL legislation, there's some things that might, I guess that's postponed now, but there could be, some limitations there. So this gives you some more opportunities. You also have clients who are at a time in their life where the fixed income is important, so that can be valuable for them as well. And so that could be something that we want to consider. And so, that's something that we want to help to avoid, passing the tax on to the kids, but we also want to be able to provide them with this structured inheritance. If you're an advisor that does tax and trust planning, I think it's important because you're probably aware of some of your clients' non-cash assets, maybe have a little better handle on knowing whether it would be advantageous for them to reposition some of these assets to create some of the tax benefits that are available to them. And so one last point, on your behalf is if you're looking for a way to be able to increase your production without having to add new clients, then you may want to consider these programs. And the reason I say that is because most of the cases that we do are done with clients, existing clients, using current existing assets. And a lot of times, again, they're just assets that are left on the table. You really don't have that many places where you can go to create this much tax deduction for your clients, and I think this is a great way to do that. And so this is just really simply a way to keep the IRS from being a major beneficiary, part of that nest egg of your clients. Because when we can resolve that issue of passing taxes to the children and providing additional tax savings, it's a popular discussion with your clientele. Could certainly be a new reason to communicate with them. And so that's all I want to share with you at this point in time. And so I'm going to open up the phone there for Greg, if you want to add or question or anything at this point in time. And that's all I have to present. And thank you to you guys, Greg, at TWH. Appreciate you giving us the opportunity to share some of these ideas today, obviously.
Jim, thanks a lot for your time. I think you did a great job. I don't think of a thing that I would want to ask. We'll follow up with you if we get any questions back that we don't know how to answer. But no, I think you covered it perfectly. This is a great concept. You even threw in some things that I didn't know, and I thought I knew everything about this.
Good. Well, I know you'd be a hard one to stump, and so that's encouraging to hear that.
No, that was really good. Thank you.
All right. Well, thank you again. So we certainly appreciate it, and I look forward to talking to some of the advisors about how we might be able to help them help their clients and increase their production in their own practices. So again, thanks so much for having us on board today. Appreciate it.